On December 29th, 2025, silver prices carved a vertical line into the financial charts that defied decades of market behavior. Within a single trading session, the metal flashed from $79 to $83.71 before collapsing to $74.47, creating what technical analysts call a shooting star candle, a formation that traditionally signals the death of a rally. For millions of investors who watched their screens in disbelief, the question became unavoidable: did the bubble just burst? The $9 swing represented more than volatility. It represented a stress test of the entire precious metals thesis that has been building since the monetary experiments of 2020. To understand what happened on that Monday morning requires going beyond the surface panic. It requires examining the architecture of modern commodity markets, the physics of liquidity deserts, and the historical patterns that reveal whether this was an ending or an acceleration. The shooting star candle is not merely a chart pattern. It is a psychological battlefield frozen in time. The long upper wick represents rejected prices, the moment when buyers pushed upward only to be overwhelmed by sellers who drove the price back down, leaving a small body and a towering shadow of failure above. In classical technical analysis, this formation appears at market tops, when euphoria reaches its peak and reality intervenes. The textbook interpretation suggests exhaustion. The bulls made their final charge up the hill, planted their flag at the summit, and then discovered they were alone with no reinforcements coming. But markets are not textbooks, and context determines whether a pattern is prophecy or distraction. A shooting star at the end of a decade-long advance carries different weight than one formed during a holiday week with skeleton trading crews and algorithmic systems battling in thin air. The critical variables are volume, volatility regime, and underlying structural demand. When these three factors are analyzed together, they reveal whether the shooting star is a reversal or a reset, a top or trapdoor that just eliminated weak positioning before the next phase. To understand December 29th, 2025, we must first map the terrain that led to that moment. Silver began 2024 trading near $23 per ounce, trapped in a multi-year consolidation pattern that had frustrated investors since the 2021 peak at $30. Throughout 2024, three structural forces were quietly converging beneath the surface. The first was industrial demand acceleration. Global solar panel installations reached 520 gigawatts of new capacity in 2024, with each gigawatt requiring approximately 11 tons of silver, according to the Silver Institute's preliminary data. The second force was monetary instability masked by central bank interventions. The United States federal debt crossed $36 trillion in November 2024, with interest payments alone consuming $1.2 trillion annually, more than the defense budget for the first time in modern history. The third force was the physical supply deficit. The Silver Institute projected a 215 million ounce shortage for 2024, the fourth consecutive year, where fabrication demand exceeded mine supply plus recycling. These forces remained dormant in price action until October 2024, when silver broke above $32 for the first time since early 2021. The breakout was quiet, almost ignored by mainstream financial media still fixated on technology stocks and artificial intelligence narratives. By December 2024, silver had climbed to $38, a gain of 65% from the January lows. The move was steady, methodical, and accompanied by rising open interest in futures markets, a sign that the rally was structurally supported, not speculative froth. Then came 2025, and the acceleration began in earnest. January 2025 saw what traders call the pension fund effect, the annual rebalancing where institutional portfolios reset allocations based on prior year performance. Silver's 65% gain in 2024 triggered automatic buy programs from commodity trading advisors and systematic trend followers. By February 2025, silver had crossed $50, a psychological barrier that had held for over a decade. March 2025 brought geopolitical fuel to the fire. Tensions in the Taiwan Strait escalated when semiconductor export restrictions tightened, reminding markets that 60% of global chip production relies on a single island, and every advanced chip requires silver for connectivity and thermal management. By June 2025, silver reached $65, and the narrative shifted from industrial commodity to monetary hedge. Gold had crossed $4,000 per ounce in April 2025, propelled by central bank purchases that exceeded 1,000 tons for the third consecutive year, according to World Gold Council data. The gold-silver ratio, which had languished above 80 for years, compressed to 65 by mid-2025. This compression indicated silver was beginning to catch up to gold's monetary premium, a pattern last seen during the late 1970s precious metal surge. Summer 2025 was marked by mining supply disappointments. Major producers, including Pan American Silver and Hecla Mining, reported production declines due to aging ore bodies and permitting delays for new projects, tightening the physical supply even as demand continued its relentless climb. By December 2025, silver had reached $71.91 at the close of Friday, December 26th. The market was entering what traders call Ghost Week, the period between Christmas and New Year's when trading desks are understaffed, liquidity evaporates, and price discovery becomes erratic. Then came Monday, December 29th, 2025. Asian markets opened Sunday night with silver gapping up to $79, driven by weekend headlines about currency instability in emerging markets and continued safe haven flows into hard assets. Within the first hour of trading, price accelerated to $83.71, a move so violent that it triggered exchange scrutiny and algorithmic circuit breakers. The velocity was unsustainable, the order book too thin to support the weight of momentum. What followed was a textbook liquidity cascade. Large holders began taking profits at the psychological 80+ level, and their selling hit a market with no buyers in the middle ranges, the classic air pocket created by holiday week absence. The price fell through $80, then $78, then hit the critical $75 level where stop-loss orders from leveraged traders were clustered. When $75 broke, a wave of forced liquidations triggered, pushing silver to an intraday low of $74.47 before stabilizing. By day's end, silver closed near $78.36, still up 9% from Friday's close, but bearing the scar of that long upper wick, the shooting star that now dominates the daily chart. The volume was heavy, but not record-setting, indicating that while the move was dramatic, it was not a mass exodus. To interpret December the 29th correctly requires separating the paper market from the physical reality beneath it. The $9 intraday swing occurred entirely in futures and derivatives contracts, financial instruments that derive value from silver but represent no actual metal. The physical market told a different story. Dealers in major markets from New York to Singapore reported no flood of selling from retail holders and no collapse in premiums despite the paper price volatility, according to industry sources monitoring real-time inventories. This divergence reveals the true nature of the shooting star. It was a leverage purge, not a demand collapse. The flash to 83.71 attracted speculative traders using margin and options, and the subsequent crash liquidated those positions while leaving the underlying physical bid intact. Industrial buyers, who had watched silver climb from $23 to $83 in less than 24 months, saw the dip to $74 as an opportunity rather than a warning. Procurement managers for solar manufacturers and electronics companies used the volatility to secure inventory at discounts, absorbing the paper selling and converting it into delivery requests. The algorithmic systems that dominate short-term trading saw the shooting star as a volatility spike and reduced position sizing accordingly. This creates the choppy, range-bound trading that typically follows such formations, prices oscillating between support and resistance while the market digests the move. But the monthly chart reveals what the daily chart obscures. Even with the shooting star, December 2025 is on track to close above $75, which would mark the highest monthly closing price in silver's history and the completion of a massive multi-year base breakout pattern. The gold-silver ratio currently sits near 57, down from 90 just 2 years ago. This compression indicates that silver is reclaiming its monetary characteristics, moving from pure industrial commodity toward hybrid status as both critical material and store of value. Central bank behavior continues to support the precious metals thesis. Global reserves now hold over 37,000 tons of gold, with emerging market central banks adding to positions despite elevated prices, a sign that monetary authorities are hedging against the currency system itself. The Federal Reserve's balance sheet remains above $7 trillion despite modest quantitative tightening attempts in 2023 and 2024. The structural reality is that debt to GDP ratios across developed economies have reached levels historically associated with either default or inflation, and there is no political will for the austerity required to resolve them. Silver sits at the intersection of these forces: the energy transition that requires massive material inputs, the semiconductor industry that depends on stable supply chains, and the monetary system searching for alternatives to fiat currencies that have lost 98% of their purchasing power since 1971. The shooting star candle of December 29th has created a technical resistance zone near $83 that will require time and accumulation to overcome. Traders who bought at the top now represent a supply overhang. When price returns to their entry point, some will sell to break even, creating friction. This technical resistance is temporary, measured in weeks rather than months. The structural drivers that propelled silver from $23 to $83 have not reversed, they have intensified. The supply deficit continues to widen. New mine development requires 7 to 10 years from discovery to production. and the pipeline of major new projects is the thinnest in decades due to underinvestment during the 2011 to 2020 bear market. Recycling cannot fill the gap because silver is consumed in applications where recovery is economically unviable. Trace amounts in electronics, permanent installation in solar panels, and dispersed use in medical devices. Unlike gold, which is almost entirely recyclable because it serves primarily as store of value, silver disappears into the technological infrastructure. The coming months of 2026 will likely see continued volatility as the market transitions from the early parabolic phase into the grinding advance that characterizes mature bull markets. The path to $100 per ounce will not be a straight line. It will be a staircase with each step consolidating before the next push higher. Institutional capital, which has been largely absent from silver markets for over a decade, is beginning to take notice. When a commodity moves from $23 to $83 in less than 2 years, it crosses the threshold where portfolio managers can no longer ignore it without explaining to clients why they missed the move. The pension funds and endowments that rebalance in January 2026 will see silver's 2025 performance and adjust allocations accordingly. This systematic buying adds a persistent bid beneath the market that dampens downside volatility while supporting upward pressure. Geopolitical tensions show no signs of easing. The Taiwan situation remains unresolved, the Middle East continues to simmer with proxy conflicts, and the global fracturing into competing economic blocs. The West versus the BRICS Plus alignment creates incentives for nations to hold reserves outside the dollar system. The currency system itself is entering uncharted territory. The dollar's share of global reserves has declined from 72% in 2000 to below 59% in 2024, according to IMF data, while alternative arrangements like bilateral currency swaps and gold-backed trade settlements proliferate. The shooting star candle that appeared on December 29, 2025, is not the death of the silver rally, it is the clearing of the deck before the next phase. Markets do not move in straight lines, they advance in waves, and each correction shakes out the weak hands while setting up the next impulse higher. History provides the roadmap. In 1979, silver began the year near $6 and ended above $30, but the path included multiple 20% corrections that convinced observers at each dip that the rally had ended, until it resumed and ultimately reached $50 in January 1980. The current setup bears structural similarities to that period. Massive fiscal deficits, negative real interest rates despite nominal rate levels, supply constraints in physical metal, and a monetary system showing visible stress fractures. The differences favor a more sustained rally this time because industrial demand now provides a floor that did not exist in 1980. The truth about today's shooting star is that it represents a liquidity event in a transitional market, not a fundamental reversal. The $9 swing was violent, painful for those caught on the wrong side, and ultimately healthy for the long-term trend because it removed excess leverage that would have caused greater instability at higher prices. For investors positioned in physical metal rather than leveraged derivatives, the shooting star is merely noise on a chart. An ounce remains an ounce regardless of intraday volatility, and the forces driving revaluation of precious metals relative to fiat currencies are measured in years, not days. The bubble has not burst because there was no bubble. There was a correction in a structural bull market that still has years to run. The distinction matters. Bubbles end when fundamentals are revealed as fraudulent, while corrections end when weak positioning is cleared and the underlying demand reasserts itself. As 2025 closes and 2026 begins, silver stands at a critical juncture. The shooting star will either be remembered as the top, a warning that went unheeded, or as the midpoint consolidation before the real acceleration toward triple digits. The answer will be written by the physical deficit, the industrial demand curve, and the monetary system's ability to maintain confidence in unbacked paper. Based on those structural forces, the shooting star looks less like an ending and more like a pause before the climb resumes.